Today I'm going to speak to you about the 6th Motor Insurance Directive, which we've heard itterings about so far. And I'd like to speak to you in particular about Articles 10A and 25A and how it pertains to Ireland. Article 10A is for the protection of injured parties in respect of damage resulting from accidents occurring in their member state of residence in the case of the insolvency of an insurance undertaking. Article 10A will deal with insolvencies on a national level. In essence, it introduces the requirement to establish a motor compensation fund which will be used to compensate injured parties in a timely manner in the instances where an insurance undertaking becomes insolvent. Article 25A requires Member States to appoint a protection of visitors insolvency body. The main difference with Article 25A from 10A is the accident occurs in another Member State other than the one where the injured party resides. Now, the main change with the introductions of 10A and 25A is the move away from a host-based system to a home-based system. Currently, Member States operate a host-based system for all non-life insurance. Under this, compensation is paid by the Member State in which the risk is located. For example, we all are familiar with the Setanta case. It was regulated in Malta, but when it went into liquidation, Ireland was responsible for paying the claims relating to Irish-based customers. Under the home-based scheme, compensation will be paid by the insurance compensation scheme of the member state where the insolvent insurance company is located. The reason being is it is the home member state where supervisory control takes place, and it is the home country where that initial authorisation was given in the first instance to be active in the insurance market. So in an example whereby Ireland authorises an insurer on an FOS-FOE basis to sell into Malta, for example, it is the Irish regulator that needs to have knowledge on the insurer's activities in Malta and the other member states. If that insurer was to become insolvent, Ireland, being the home country in this instance, is ultimately responsible for paying the claims. So if Setanta were to happen now post 23rd of December, it would be Malta that would have to pick up the cost and not Ireland. Now, in order to understand how the 10A 25A body will operate in Ireland, it is important to understand our current regime. The Insurance Compensation Fund is primarily designed to facilitate payments to policyholders in relation to risks in the state where an Irish authorised non-life insurer or a non-life insurer authorised in another member state goes into liquidation, and approval from the High Court has been sought to pay the claims. The ICF levy covers the cost of claims in this state where the insurer enters liquidation and applies a rate of 2% of premiums received on all non-life insurance policies. This levy is collected by the Revenue Commissioners. Now, the Motor Insurance Insolvency Compensation Fund, which we at MIBI are very familiar with, it's an ex-ante fund and managed by ourselves, and we collect contributions from motor insurers to fund the increase in the compensation from third-party motor claims to 65% to 100%, where the insurer is insolvent. The contribution rate, as David previously mentioned, is currently at 2% of gross motor premiums. Now, we'll just look at some of the main differences in respect of the current ICF missive framework as it applies to compensation for motor claims versus the requirements introduced by the new directive. In terms of purpose, the Insurance Act has two funds in the motor compensation framework, each with a very specific purpose. Under the directive, there is no requirement on funding or processes. In terms of scope, ICF, including missive, requires contributions from insurers for all classes of motor business. That encompasses classes 10, 1D, 3 and 7. It also covers compensation from each of these classes. The directive only covers class 10 motor third-party liability. In terms of funding, the funding process under the Insurance Act is very detailed and the governance requirements, and there's very specific provisions on the contributions from industry and loans from the Minister for Finance. The directive only requires that member states provide for sufficient funding to pay the claims. It also notes that contributions can only be sought from insurers domiciled in Ireland. As previously mentioned, the ICF and MISIF is a host-based system, but the directive requires us to move to that home-based scheme. In terms of the claim limits, the current framework, there is no upper limit for a bodily injury claim. Under the directive, the compensation limits are aligned to Article 9, the compulsory cover limits, and Denis will elaborate on this later in his presentation. In terms of claims processes, there's detailed requirements and governance set out in the Insurance Act, including approval of claims payments by the High Court. Under the directive, the insolvency body must make a reasoned reply within 3 months of the application and pay the victim's compensation within 3 months of that offer being accepted. The timeframes here are extremely tight and actually don't really align with the High Court process that's already in play. So you may ask who's going to be the 10A 25A body for Ireland, and the Minister somewhat addressed it in her speech. And the Department of Finance have asked MIBI to be the motor compensation body. Now we're working with the government closely on this, and of course we will keep you, our members and stakeholders, updated as the matter progresses. The motor compensation body will also need to be put on a statutory footing, and we understand this will be done via the Motor Insurance Insolvency Compensation Bill 2023. Another element to note here is that there's agreements required between all the insolvency bodies and POV insolvency bodies. The COB, or Council of Bureau, as David referred to earlier, have drafted these agreements. Now, they need to be signed by every single insolvency body prior to the 23rd of December. If they are not signed, the European Commission can impose delegated acts. Delegated acts would be much less desirable, as we would cede control to the Commission and the ability to amend these agreements in the event of unforeseen difficulties that may arise when the new regime is put into place. We continue to work with the COB, but as you can imagine, it's extremely difficult to try and get 30 countries to sign the COB agreements while they're all grappling with implementing their own legislation for the 6th MID. In Ireland's case, we've reviewed the wording in the COB agreements. We believe it to be broadly acceptable, but we're not in a position at the moment to sign that agreement, as the implementing legislation is just not sufficiently advanced. Now, in order to work through the other MID requirements, the Department of Finance have set up a MID transposition working group with the key stakeholders, including ourselves, and you can see the other key stakeholders up on the slide there, and the Minister named them to be a few. The terms of reference and the objectives of that MID working group were really to consider the legislative requirements arising out of Articles 10A and 25A, to discuss how to best integrate the changes that MID will bring into our current framework, and I've outlined that, to consider the amendments underpinning the legislation and the establishment of the motor compensation body, to look at the increased liability arising from that new home-based system that we talked about, and to discuss how adequately to fund the new financial exposure that we'll find ourselves in, to ensure a pragmatic approach is taken to managing the new funding needs and the requirement to no longer seek contributions from motor insurers who write into Ireland on an FOS/FOE basis, and in designing any new changes to be cognisant of the spirit of the directive. The working group has met regularly since the beginning of the year, and one of the key issues that we've discussed in that grouping is how best to integrate MID into the current ICF system. 3 options were looked at. However, option 1 up there, to overlay MID onto the current ICF system by bringing in the MID amendments into the existing structure, was the preferred option. The advantages of this are that minimal changes are needed given the required tight time frames. It lessens the transitionary impact on the ICF, and it also maintains flexibility to include resolution funding as a function of the ICF. The disadvantages, which are outweighed by the advantages, are that it creates complexity in having different rules for different lines of business, and there's continuation of 2 different funds, which can be more expensive. Other considerations agreed by the MID working group were how legacy debt issues should be handled, what if any new levy model should be introduced, and we're giving consideration there to an ex ante before the event fund, an ex post after the event, or a combination of the 2, the role of the courts to meet those new compensation timelines that I referred to, and the governance and accountability of the motor compensation body. Now, all of those MID working group discussions will form the basis of the new Motor Insurance Insolvency Compensation Bill, the aims of which are outlined there on the slide. All of the stakeholders in the working group received a copy of the general scheme in early September, and we, in conjunction with our legal advisors, William Fry, have provided initial feedback on the scheme to the Department of Finance. There are some open issues which will need to be addressed as part of the drafting phase, some of which are like the funding mechanism and the working capital for the MCB from the Exchequer, what that new levy will be, who the collection agent for the levy will be, recoverability of our legal defence costs and motor compensation body expenses, clarification on the applicability of the RBA, guidance on accounting treatment, and the extension of the tax exemption that MIBI currently receive for administering the MISA fund, which is given under the Finance Act. Now, that transposition deadline of the 23rd of December is really fast approaching, and there is a huge volume of work to do in order to meet the deadline. I'm just going to give you outline a few of those key steps that will need to be taken. It is difficult to give a proposed timeline, but these are the key steps that will give some information on the process the department will be targeting over the next few months. So in October, the Department of Finance will be seeking formal approval on the draft general scheme. It has also been confirmed, and the Minister reaffirmed it here, it's on the priority legislation list, which is brilliant news. And hopefully we will be motoring along, as she said. The general scheme will need to be submitted then to the Pre-Legislative Scrutiny Committee, and publication of the general scheme on the Oireachtas website will need to take place. The general scheme then goes to the Office of Parliamentary Counsel's drafting of heads, and thereafter public consultation will need to take place. If there's a change to the CBI, then an ECB consultation process needs to take place also. And then the next stage would be for it to go to the Pre-Legislative Scrutiny Committee for consideration, and that process can take up to 8 weeks. The finalisation of the draft heads will then take place before it goes for publication, and that includes engagement with the drafter. The Department of Finance will come back to the members of the MID working group. Ministerial and government approval will be required, and then it needs to go through all stages of the Oireachtas. From an MIBI perspective, if we are to be the motor compensation body, we will need to hold an EGM to change our MIBI constitution. And then lastly, we're getting towards December now, where the last day of the Dáil sitting is the 14th of December, so that is our last opportunity to pass the bill in order to meet that target deadline. So as you can see there, there's a large mountain of work and a large volume to do in order to meet the deadline. But we here at the MIBI are committed to working with the Minister and her department and other key stakeholders in order to meet this important deadline. Thank you. I'm just going to bring Denis back up to the stage. He'll take you through the other elements of the Motor Insurance Directive.
Thanks, Aisling. So Ireland, like other EU countries, continue to work on transposing the directive into Irish legislation. The MIBI continue to engage with the Department of Transport with a view to support in transposing the directive and offering an MIBI and member perspective. And as David mentioned earlier, this will lead to an update of the MIBI agreement, and we hope to conclude this in 2024. Transposition of the transport-related elements will be done via a statutory instrument. This is where ministers have delegated power to issue rules and orders to bring Ireland in line with the directive. The Department will use the SI as permitted by the European Communities Act, which empowers ministers to make regulations to implement directives, to amend the respective sections of the Road Traffic Act. For this reason, there will be no requirement to engage with the Oireachtas, unlike Aisling's issues there, to transpose the RTA elements of the directive, and this will ensure that the relevant legislation is enacted before the December deadline. Also, MIBI continue to engage with our members on getting specific input and feedback, and this is something that the Department has been very open to and actively encouraged. Some of the pertinent articles that relate to the Department's plans to implement the directive are Article 1, which outlines the definition of vehicle and use of vehicle. There will be a new definition of vehicle and the introduction of use of vehicle to the RTA. Article 3 requires a minimum obligation for compulsory MTPL insurance on all motor vehicles. It also introduces an exclusion for motorsport-related activities. Article 5.5 introduces a derogation for vehicles not admitted for use on public roads. And Article 5.6 is the mechanism that the Department will use to apply the derogation, utilising the state's national competency. The definition of mechanically propelled vehicle in the RTA will be replaced with a new definition from the directive. Any vehicle that meets the new criteria will need MTPL insurance as required under Article 3. So, a vehicle is now defined for insurance purposes as any motor vehicle propelled exclusively by mechanical power on land, but not running on rails, with a minimum speed of more than 25 kilometres per hour or a maximum weight of more than 25 kilograms and a maximum speed of more than 14 kilometres per hour. And then any trailer used with a vehicle, whether it is coupled or uncoupled. Using this new definition, the Road Traffic and Roads Act introduces a new category of vehicle called Personal Powered Transporter. PPTs will not require insurance similarly to pedal bikes. Vehicles that remain outside the definition of PPT, so very high-powered e-scooters or e-bikes, for example, will still be defined as a vehicle. While the Road Traffic and Roads Act has been enacted, the introduction of all new technical regulations is subject to examination by the EU Commission, and there is a 12-week period where the Commission review the Irish legislation to ensure that it's compliant with the directive. So it will be later in Q4 before we see that PPT legislation in force. And even after the PPT elements of the Act come into force, claims involving vehicles that remain outside the definition of vehicle will still likely fall under the remit of the MIBI. However, the burden of proof will rest with the claimant to establish that the vehicle was indeed a high-powered e-scooter or e-bike. The directive codifies the CJEU cases of Vanuk and Rodriguez and adds a new definition of use of vehicle. Vehicles that are intended to serve as a means of transport, irrespective of their characteristics, and covers any use of vehicle consistent with its function as a means of transport, irrespective of the terrain it is used on or whether it is stationary or in motion. The Department will introduce this definition into the RTA via the SI mentioned earlier. And again, referencing this definition and the compulsory requirements under Article 3, the SI establishes that if a vehicle is covered by an MTPL insurance policy, that it will be required to provide an indemnity for an accident, whether it occurred in a public or private place. Therefore, it will not be possible to exclude claims that took place on private land. However, this definition, with the CJEU cases in mind, will exclude claims where a vehicle is used solely as a stationary machine. Article 3 already requires compulsory MTPL insurance on all motor vehicles. However, the directive makes provision to exclude motorsport-related activities. So it will not apply to use of vehicle in motorsport events, but importantly, there needs to be alternative insurance in place with equivalent coverage to the directive. If insurance is not in place, the MIBI will handle any third-party claims that arise during these events, but not for the competitors or the vehicles involved. While this isn't an ideal situation for motor insurance consumers, it does ultimately protect innocent victims. But rest assured, MIBI will vigorously seek to recover from any respective parties. It's vitally important that county councils have the correct licensing in place and Motorsport Ireland have adequate insurance to cover third-party claims. MIBI are working with the department to get clarity from the local government management agency, who support all 31 local authorities, to ensure there are appropriate policies and procedures in place, including checking insurance prior to certifying an event. And indeed, once the SI has been published, MIBI will write to all the councils, reminding them of the importance of operating a clear licensing and authorisation process. While Article 3 requires compulsory MTPL insurance, Article 5.5 allows Member States to derogate for vehicles not admitted for use on public roads. This allows the department to derogate not only from the requirement for compulsory insurance, but also to derogate the nominated compensation body, which is the MIBI, from having to compensate accidents involving these derogated vehicles. The basis of this relies on the last sentence of 5.6, referencing due to a legal or physical restriction on access to such areas as defined by national laws. Therefore, the department will use the derogation to make the necessary amendments to the RTA. However, in our discussions, the department emphasised that vehicles moving between private and a public place will be required to have MTPL insurance. This will have significant implications for the MIBI, as distinct from the wider insurance market. The derogation will only apply to MIBI in cases where the vehicle is uninsured and the accident occurs in a private place. In other words, if the vehicle is covered by an insurance policy, the derogations will not apply, and the insurer will have to indemnify accidents in all places. If the vehicle is uninsured, the derogation will apply, and the MIBI will not be able to compensate the victim. In essence, the department, in applying this derogation, is highlighting the distinction between the responsibilities of the state, the motor insurance market, and the vehicle or driver. The state is required to implement and transpose the directive into national legislation. The motor insurance market is required to ensure that their policies fulfil the conditions of the directive, particularly in respect of Article 1, use of vehicle, and the compulsory requirements under Article 3. And furthermore, the driver or the vehicle owner ultimately has a responsibility to insure their vehicles. I must caveat this interpretation, especially with some of the guests in the auditorium, that this interpretation is based on the latest feedback from the department on how they plan to apply the derogation. It's premature to give a definitive comment until we have sight of that legislation. The 2009 directive established the concept of minimum obligatory amounts of insurance coverage for motor insurance. The updated directive revises these amounts, and the department will again use the SI to update the RTA to reflect the revised minimum amounts of cover where required. Therefore, property damage increases from 1.22 million to 1.3 million, and while Ireland already has unlimited personal injury compensation, in other EU countries that cap personal injury damages, the directive will increase this to 6.45 million per accident. Thank you very much.